In June alone, roughly $2.3 trillion evaporated from the combined market value of America's biggest technology companies, and almost nobody watching the headlines understood why hedge funds were quietly celebrating instead of panicking. While retail investors watched their favorite big tech names bleed red, some of the smartest, best resourced money on the planet was doing something almost nobody expected. They were selling their magnificent 7 stakes and using that cash to buy up Chinese technology companies instead, with quantum computing sitting right at the center of that rotation. If you have never heard, this actually wins the next great technology race, and it is unfolding far faster than most public commentary has managed to keep pace with. Let's start with the number that should genuinely stop you in your tracks. I want you to sit with that number for one more moment before we move on, because $2.3 trillion is not in wiping out the entire combined stock market value of countries like Canada or Australia, all in the span of about 30 days, from companies that had spent the previous several years being treated as the single safest, most obvious bet in the entire global smartest people in the room actually see coming that everyone else missed. Throughout the month of June, as investors, something cracked. The combined market capitalization of the so-called Magnificent Seven, the handful of American technology giants that have driven nearly the entire stock market's gains over the past several years, plunged by roughly 10% in a single month. That is not a rounding error. That is trillions of dollars of value simply disappearing in a matter of weeks from companies that had spent years being treated as untouchable, can't lose, must own positions inside nearly every major institutional portfolio on the planet. Here is where the story gets genuinely interesting, though, because this was not simply a broad market panic where everything sold off together, the way a genuine crisis or recession scare typically drags every single sector down together, regardless of individual company fundamentals. According to industry reports tracking hedge fund positioning, funds had already started meaningfully, trimming their Magnificent Seven exposure as early as May, weeks before the public sell-off even became visible in the headlines. And they were not just sitting on that cash in a money market account waiting nervously for the storm to pass. They were actively rotating it directly into Chinese companies listed on American exchanges, scooping up shares of names like Alibaba, PDD Holdings, and Baidu at a pace significant enough that these specific stocks Chinese-American depositary receipts across the entire hedge fund industry. Think about what that actually means for a moment. The exact same institutional investors who spent years treating American months before most retail investors even noticed anything unusual happening beneath the surface of the market. Why so many everyday investors are only hearing about it now? Well, after the smartest money already had a considerable head start. So what exactly triggered this shift, and why does quantum computing specifically sit at the heart of it? To understand that, you need to understand the brutal economic math currently playing out between American and Chinese artificial intelligence models, because it is genuinely reshaping how sophisticated investors think about where the real competitive advantage in technology actually sits going forward. Consider the pricing gap between leading American and Chinese AI systems right now. A leading American model from OpenAI costs roughly $5 per around 44 cents and 87 cents respectively for the same categories of usage, with an even lighter version pushing those costs down further still. That is not a minor efficiency advantage. That is roughly a 10 to 20 times cost advantage on the exact metric that ultimately decides whether artificial intelligence at scale is actually commercially sustainable or not. And it is precisely the kind of gap that eventually shows up not in a press release, but directly in where capital quietly decides to flow next. One prominent investment strategy group put this shift in genuinely blunt terms in a recent portfolio recommendation, stating its current clients to go long on sectors benefiting from broader AI deployment and to pay particular attention to China specifically. When a firm advising serious institutional money starts using language that that is not a subtle hedge. That is a genuine directional bet that the center of gravity in next-generation technology may be shifting somewhere most Western investors have spent years underestimating. It is worth pausing here to understand exactly why cost efficiency matters so enormously in an industry that most people still think about purely in terms of raw technical capability rather than sustainable business economics. Building and running massive artificial intelligence models is extraordinarily expensive, requiring enormous data centers, staggering amounts of electricity, and cutting-edge computing chips that themselves cost a small fortune to manufacture and deploy at business applications, rather than remaining an impressive but financially unsustainable research showcase. Investors managing capability into durable, scalable profit. And right now, a growing number of them are concluding that math increasingly favors companies operating out of China rather than Silicon Valley. Now, let's connect this directly to quantum computing, because the pattern playing out there mirrors this broader rotation almost perfectly. and arguably represents an even more extreme version of the exact same story. Back in May, the Trump administration's Department of Commerce announced a funding package worth just over $2 billion, distributed under the CHIPS and Science Act, aimed squarely at accelerating America's domestic quantum computing industry. The money went to 9 separate companies and 2 dedicated quantum chip foundries, with IBM alone receiving a full $1 billion to build a new subsidiary focused specifically on quantum-grade superconducting wafers, and GlobalFoundries receiving $375 million to establish America's first dedicated quantum foundry. American markets reacted almost instantly, and the reaction was genuinely explosive. Over just 2 trading days following that announcement, shares of Inflection soared, typically associated with explosive short-term stock moves. It gained around 13% in that same brief window. For context on just how unusual that kind of 2-day move actually is for established large-cap technology stocks, moves of that size typically only happen around major earnings. Here's the part almost nobody in Western financial media bothered to report with the same level of attention. Chinese quantum stocks did the exact same thing at almost the exact same time for the exact opposite reason. Investors in Shanghai and Shenzhen watched Washington's funding announcement and immediately concluded that Beijing would respond in kind to avoid falling behind in what both governments now openly treat as a genuine national security when to prominent publicly traded quantum companies surged 19% in just 2 trading days. Gochuang Software gained nearly 18%. Coal software climbed almost 10%. The exact same catalyst, American government spending on quantum technology, simultaneously ignited stock rallies on both sides of the Pacific, which tells you everything you need to know about how tightly intertwined and competitively mirrored this entire race has genuinely become. Think about what that mirrored reaction actually reveals about how global markets now genuinely perceive this specific technology race. A single funding announcement from one government, aimed purely at strengthening its own domestic industry, instantly moved stock prices. Thousands of miles away in a completely different market, governed by a completely different regulatory system, denominated in a completely different currency. That kind of instant, correlated reaction does not happen for niche, obscure technologies nobody particularly cares about. It happens specifically when global capital markets have already collectively decided a particular technology sector represents a genuinely serious, high-stakes strategic competition between major world powers, the exact same category of market behavior historically reserved for things like semiconductor manufacturing, rare earth minerals, and advanced military hardware. Origin Quantum had just launched its 4th-generation superconducting quantum computer, called Origin Wukong 180, further cementing the company's position as one of the clearest technical leaders inside China's rapidly maturing domestic quantum ecosystem. That timing matters, because it demonstrates this was not simply a reactive market responding purely to American headlines. China's quantum sector was already moving under its own considerable momentum, and Washington's funding announcement simply added extra fuel to a fire that was already burning steadily on its own. But here's where the story shifts from simple stock market symmetry into something considerably more significant, because China's commitment to quantum computing did not actually start with a reaction to America's funding announcement. It had already been building steadily for years, quietly, methodically, well before most Western analysts were paying close attention. China's newly adopted 15th Five-Year Plan, covering this period from 2026 through 2030, formally named quantum technology as the very first of 7 priority future industries the country intends to build its next-generation economy around. That list also includes biomedical research, hydrogen and nuclear fusion energy, brain computer, interfaces, embodied artificial intelligence, and next-generation 6G telecommunications, but quantum sits explicitly at the very top of that ranked priority list. Backing up that stated priority with real capital, China's National Venture Guidance Fund has already allocated the equivalent of roughly $17.5 billion across 3 dedicated regional investment vehicles specifically targeting quantum development, covering the Beijing-Tianjin-Hebei region, the Yangtze River Delta, and the Guangdong-Hong Kong-Macau Greater Bay Area. China's overall government investment in quantum technology is now widely cited by independent research organizations at approximately $15 billion total, a figure that includes massive dedicated infrastructure projects like the Hefei National Laboratory for Quantum Information Sciences, an absolutely enormous 37-hectare research campus that alone is estimated to have absorbed roughly $10 billion in investment on its own. To put that spending in real perspective, China's cumulative government commitment to quantum technology now sits directly comparable to, and in some specific funding categories, exceeds what the United States federal government has committed to the exact same field. And unlike some of America's more scattered company-specific funding announcements, China has explicitly structured its investment as coordinated national industrial policy, placing quantum computing on par with semiconductors and artificial intelligence as a defining strategic priority for the entire coming decade. The private investment side of this story is moving just as aggressively. According to Chinese venture capital tracking data, the domestic quantum computing sector recorded roughly 150 separate financing events, totaling the equivalent of just over $1.5 billion in only the first 3 months of 2026 alone, a figure that nearly matched the entire total raised throughout all of the previous year combined. Chinese quantum company SpinQ reported 80% year-over-year order growth in the first quarter of this year, with its superconducting quantum business now accounting for a majority of its total revenue, a genuinely rare thing to see in an industry where most companies worldwide are still years away from meaningful commercial revenue of any kind, and a detail worth sitting with, given how many Western analysts have long assumed Chinese quantum companies remain purely research-focused rather than commercially viable. This is precisely why sophisticated Western investors have started paying such close attention. Unlike the earlier waves of speculative Chinese technology investment that came and went over the past decade, this current wave is arriving alongside actual verifiable commercialization milestones, not just ambitious roadmaps and government press releases. Origin Quantum, one of China's leading quantum hardware companies, now operates the country's only 6-inch quantum chip production line, running at a daily capacity exceeding 100 wafers with a yield rate above 92%. And its 180-qubit superconducting quantum computer is already available as a functioning online cloud, service that real customers can actually use today, not merely a laboratory prototype sitting behind closed doors. There is a genuinely fascinating twist buried inside this entire story, too, one that reveals just how differently pressure and restriction can play out depending on how a country responds to it. Years ago, the United States placed export restrictions on several major Chinese quantum companies, including Quantum C-Tech and a number of affiliated Chinese Academy of Sciences research institutes, explicitly intended to slow down China's progress in this exact field by cutting off access to critical Western components and technology. The actual practical effects turned out to be almost the complete opposite of what those restrictions were designed to achieve. Rather than crippling Chinese quantum development, those export controls triggered what industry analysts now openly describe as a genuine crash program inside China's domestic supply chain, forcing rapid, accelerated development of homegrown dilution refrigerators, low-temperature electronics, and specialized photonic components that China simply did not previously need to build for itself. Origin Quantum now manufactures and exports its own dilution refrigerator technology to countries participating in China's Belt and Road Initiative, a capability that genuinely did not exist inside China just 3 years ago, arguably created directly as an unintended consequence of the restrictions specifically meant to prevent exactly this kind of outcome. This exact pattern, restrictions accidentally accelerating the very self-sufficiency they were designed to prevent, has actually played out repeatedly across multiple different Chinese technology sectors over the past several years, and it is worth understanding as a genuinely recurring theme rather than a one-off coincidence specific to quantum computing. Similar restrictions targeting Chinese semiconductor manufacturing pushed domestic chip producers to rapidly develop alternative manufacturing techniques that Western companies had never seriously needed to pursue. Restrictions on advanced artificial intelligence chip exports similarly pushed Chinese AI researchers toward radically more efficient model architectures that required dramatically less raw computing power to achieve comparable results, which circles directly back to that earlier point about DeepSeek's startling cost advantage over its uncomfortable lesson embedded inside this repeated pattern for policymakers on both sides of the Pacific. Restrictions designed to slow down a determined, well-funded competitor do not always work the way they were originally intended. And in some documented cases, they appear to have done the exact opposite, forcing faster, more independent innovation than would likely have happened otherwise under normal, unrestricted market conditions. If you are a sophisticated investor watching this entire picture unfold, here is exactly the calculation running through your head right now. And it is worth walking through step by step because it explains this entire rotation far better than any single headline number ever could. American big tech valuations, particularly across the Magnificent Seven, have spent years pricing in essentially flawless, uninterrupted execution on artificial intelligence, justified by genuinely massive capital expenditure commitments running into the hundreds of billions of dollars annually across the sector. The moment investors started seriously scrutinizing whether that spending would actually translate into proportional revenue and profit within any reasonable time frame, roughly $2.3 trillion of market value evaporated within a single month, a genuinely violent repricing for companies most people still consider close to bulletproof. Meanwhile, China is pursuing a fundamentally different competitive strategy across both artificial intelligence and quantum computing simultaneously, One built explicitly around dramatically lower operating costs, coordinated top-down national industrial policy, and increasingly verifiable real-world commercial traction rather than purely speculative future promises. For a sophisticated global investor managing genuinely enormous pools of capital, that combination of factors starts looking less like a fringe, high-risk speculative bet, and considerably more like a legitimate diversification play against an increasingly crowded, increasingly expensive, and increasingly scrutinized American technology trade that had grown dangerously concentrated in just a small handful of household names. None of this means American quantum companies are somehow losing this race outright, and it would be a serious mistake to walk away from this story thinking otherwise. IonQ, currently the largest publicly traded pure-play American quantum company by market value, posted revenue growth of over 700% year over year in its most recent quarter, and recently booked its first 256-qubit system sale to the University of Cambridge, a genuinely deployment. IBM continues advancing its own ambitious quantum roadmap, targeting a fully error-corrected, fault-tolerant quantum system, over 3 trillion individual programs for real research organizations and enterprise clients. Rigetti Computing's latest 108-qubit system recently achieved general commercial availability across multiple major cloud platforms simultaneously, including Amazon Braket and Microsoft Azure. Quantum, with genuinely impressive gate fidelity numbers that place it among the most technically capable systems currently available anywhere in the world. It is genuinely worth appreciating just how quickly the American side of this race has accelerated its own commercialization. Timeline 2, since focusing only on China's momentum, would paint an incomplete, one-sided picture of what is actually happening. Across the industry as a whole, D-Wave Quantum has continued expanding its own commercial contract pipeline, providing near-term revenue support that distinguishes it from some of the more purely speculative names in the sector. Quantinuum, backed by the deep pockets and decades of research experience behind Honeywell, is preparing for its own anticipated public listing, potentially arriving as a Honeywell spin-off sometime in the coming year, which would give everyday investors a considerably more direct route into a company widely regarded as filling a genuinely important middle ground between purely speculative pure-play startups and the more conservative, diversified technology giants like IBM and Microsoft. PsiQuantum, having already raised over $1.3 billion in funding from heavyweight global foundries, is similarly positioning itself for a public offering sometime this year. None of this progress happening on the American side cancels out or diminishes what is simultaneously happening inside China. It simply confirms that both countries are racing forward at genuinely remarkable speed, simultaneously each pursuing meaningfully different strategic approaches, different cost structures, and different underlying philosophies about exactly how quantum computing should be commercialized and scaled. That is precisely why sophisticated investors are increasingly reluctant to place all of their chips on just one side of this specific technological race, preferring instead to build genuinely diversified exposure across both competing ecosystems rather than betting everything on a single country, definitively winning outright. Some are even structuring positions specifically designed to profit, regardless of which nation ultimately pulls ahead, treating the entire sector as a genuine two-horse race worth backing on both sides rather than picking a single definitive winner this early in the game. The real story here is not really about one single country definitively winning and another definitively losing this race, at least not yet, and probably not for a good while. Longer, given how genuinely early stage this entire technology still remains across every major country pursuing it. The real story is about capital increasingly refusing to simply assume American technological dominance is permanent, automatic, and self-sustaining, the way it comfortably did for essentially the entire prior decade of stock market history. Smart money is explicitly starting to hedge. Defining technology race, quantum computing very much included, might not be won by a single dominant country the way so many previous technology waves comfortably were. It is worth being genuinely careful here too, because chasing this exact narrative, blindly honest acknowledgement rather than being glossed over for the sake of a cleaner story. Quantum computing stocks across both countries remain extraordinarily volatile and deeply speculative investments by almost any conventional measure. Pure-play quantum companies in the United States have posted trailing 12-month stock returns ranging anywhere from over 700% to a genuinely staggering 5,700%, numbers that reflect intense speculative premium rather than validated, sustainable underlying business fundamentals in the way a mature, cash-generating company would typically justify. Revenue across nearly every pure-play quantum company worldwide in both America and China remains genuinely tiny relative to the sky-high valuations these companies currently command, and commercially viable, broadly useful, fault-tolerant quantum computing capable of solving genuinely valuable, real world problems at meaningful scale may still realistically be the better part of a decade away. regardless of which specific country ultimately gets there first. It is worth being honest about a specific danger lurking inside speculative sectors like this one, a pattern experienced traders have watched repeat itself across nearly every emerging technology hype cycle in recent memory. When a sector delivers headline-grabbing returns in the thousands of percent, a wave of later arriving investors inevitably pile in near the top, chasing performance rather than underlying value, precisely the moment early. Disciplined investors are already quietly taking some profits off the table. Nothing in this video should be read as a suggestion that every quantum stock in either country is automatically a smart long-term holding, simply because institutional money has started paying closer attention. Genuine due diligence, realistic position sizing, and a clear-eyed understanding of just how early stage and speculative this entire technology remains still matter enormously, regardless of which flag happens to be printed on a particular company's headquarters. There's also a meaningfully important practical wrinkle specifically for everyday American investors interested in participating in this exact Chinese quantum opportunity that deserves honest, direct mention here. Several of the most prominent Chinese quantum companies currently trade primarily on Chinese domestic exchanges in Shanghai and Shenzhen, markets that remain considerably harder for typical individual American retail investors to access directly compared to simply buying a familiar American-listed stock through a normal brokerage account. Some Chinese quantum companies are actively planning eventual listings on the Hong Kong Stock Exchange specifically to help bridge that exact accessibility gap for international capital. But as things currently stand today, most retail investors watching this video are considerably more likely to gain meaningful exposure to this specific trend through broader, diversified China-focused funds, or through the widely held American-listed Chinese technology names like Alibaba, Baidu, and PDD that hedge funds have already been actively accumulating throughout this year, rather than through direct individual purchases of the specific pure-play Chinese quantum names making headlines. There are also genuinely important regulatory and geopolitical considerations specific to Chinese-listed securities that any responsible investor absolutely needs to understand before allocating meaningful capital in this direction. American regulators have periodically raised concerns about auditing transparency standards for Chinese companies listed on American exchanges, and geopolitical tensions between the two countries have occasionally introduced additional regulatory uncertainty around exactly how freely capital can move between these two markets going forward. None of this makes the underlying investment thesis automatically wrong, but it does mean anyone seriously considering this specific trade should think carefully about diversification, position sizing, and genuine comfort with a meaningfully different regulatory and political risk profile than what comes with holding a familiar, purely domestic American stock. So where does this genuinely leave you? Sitting here watching this video and wondering whether any of this actually matters for your own personal portfolio and financial future. First, understand clearly that what is happening here represents a meaningfully significant shift in how seriously billions of dollars in client assets explicitly recommend exiting the American Magnificent Seven in favor of increased China exposure. That reflects a genuine, considered reassessment of long-term competitive positioning, not casual short-term trading sector in both countries simultaneously. And position sizing discipline matters enormously here, regardless of which specific country or company you personally believe holds a genuine competitive edge going forward. Most experienced financial professionals covering this space suggest capping direct exposure to speculative quantum plays at somewhere around 3 to 5% of a genuinely well-diversified overall portfolio, treating individual stock picking within the sector as considerably riskier than simply gaining broader exposure through a dedicated quantum-focused exchange-traded fund. Third, and this part matters more than almost anything else discussed throughout this entire video, pay much closer attention to the fourth, and this is worth sitting with for a moment before we close things out. Remember that being early to a genuine long-term structural shift and being right about the eventual outcome are two very different things, separated by a timeline that can genuinely stretch across many years, rather than resolving neatly within a single dramatic months while absorbing short-term volatility along the way. Individual investors watching this video should think just as carefully about their own personal timeline and risk tolerance before attempting to mirror moves made by players with fundamentally different resources, different time horizons, and considerably deeper capacity to absorb losses along the way, if this particular thesis takes longer to play out than currently expected. The specific reason? Serious. So institutional capital started meaningfully rotating away from American big tech in the first place was not some sudden panic or irrational herd behavior. It was a genuinely careful, deliberate reassessment of whether current sky-high valuations actually match up realistically against achievable future revenue growth. set directly against a backdrop where Chinese competitors are increasingly demonstrating they can build genuinely comparable technology at a small fraction of the total cost. That exact same fundamental question, whether current valuations realistically match achievable future outcomes, applies with equal or arguably even greater force to quantum computing stocks in both countries as it does to the broader artificial intelligence trade currently dominating financial headlines. If this story genuinely opened your eyes to something happening well beneath the surface of the headlines you normally see, do us a solid favor and hit that like button right now, because stories like this one deserve to reach more people who are still only paying attention to the big tech names everyone already knows by heart. And go ahead and hit subscribe too, because we are going to keep tracking exactly how this quantum race and this broader capital rotation between East and West continues developing in the months and years directly ahead of us. At the end of the day, the real lesson buried inside this entire story extends well beyond any single stock price or any single government funding announcement. For the better part of 2 decades, big tech functioned almost as a synonym for American technology inside most investors' heads, treated as an assumption so deeply baked into portfolios that it rarely, most sophisticated capital allocators on the entire planet, in real time, with real trillions of dollars genuinely at stake. Whether China ultimately wins this specific quantum race outright or simply forces the rest of the world to compete considerably harder than anyone previously expected, one thing has already become genuinely, unmistakably clear. The era of assuming American technological dominance was simply permanent, automatic, and beyond serious question has now officially, verifiably ended. And increasingly, next chapter of this exact rotation is almost certainly still being written right now, quietly, inside trading rooms most of us will never actually see.